G'day and welcome to the Firetrail quarterly update. Thank you for joining us. With us today we have Blake Henricks, Firetrail's Deputy Managing Director and Portfolio Manager. Blake, thanks for joining us.
Thank you.
Blake, New Farm has risen around 50% over the past 2 months. Can you tell us a bit about what's actually happened there?
Yeah, so New Farm had their result, but alongside the result was a really material transaction, and that was to sell their South American business to Sumitomo. Sumitomo is a chemicals company based in Japan and also a major shareholder. They own just under 20% of New Farm. Now, the price paid was exceptional for New Farm shareholders. It was around 10 times adjusted EBITDA. And what it does, it really takes all the pressure off the balance sheet. You know, we know New Farm's had its pressure on the balance sheet from 2 consecutive Australian droughts, which have been very, very poor, and also floods in the US. And so what that's meant is the balance sheet, the debt had grown. So this transaction brings the net debt from over 3 times net debt to EBITDA to around 0.7 times. So huge win, and that's caused a massive re-rating in the share price. I think what's interesting about the transaction is it really highlights what New Farm's doing and why there's value in it. Because if you think about some of the big players in chemicals, in crop chemicals and crop protection, you've got, let's say Bayer, and they're vertically integrated from development of new chemicals all the way through to hitting the farmer. So that full vertical integration of distribution and research. Sumitomo sitting up here with the chemical research. New Farm's down here with distribution focus. So Sumitomo's concern is, well, we're creating all these great products, but can we get them to market?
Yeah.
And that's why New Farm's distribution business has really been highlighted in this transaction. Where to from here? Well, you know, for us, it's about what matters for New Farm, and it hasn't changed. The first one is taking advantage of the industry consolidation that's going on, the market share opportunities, the distracted competitors. And secondly, it's about commercialising and showing the value of their seeds business, most notably Omega-3, which today contributes nothing to earnings. They've said at the results they're going to generate sales in FY20. It's going to be cash flow or profit positive in FY21. And we believe this business is worth well over $1 billion, and you know we continue to see material upside in New Farm overall.
Well, it's exciting to see things change for a key position in the portfolio. I suppose when you look across the whole portfolio, what are some other companies that we hold within the portfolio where you can see some positive material change over the next 12 to 24 months?
The one that springs to mind where you could see a material change in people's perception is Downer. Today, Downer is an urban infrastructure engineering business. They do some of the upfront work, but they don't take a lot of fixed price contract risk. But really what they're about is taking on those long-term services contracts. Mixed amongst that business are 2 capital-heavy businesses. One is Downer's mining services business. That's a really strong business. You know, they've just recently extended on BHP's Goonyella project. But it is capital intensive. You've got to buy that equipment, so it sucks a lot of capital out. They've got another capital-intensive business, laundries, which came along with the Spotless acquisition. That capital-intensive as well. Downer have made no secret that they are looking to potentially exit those businesses. And what we believe would happen in the event of an exit is that the market would see Downer in a different light. It'd be capital light. It'd be a much simpler, more focused business, and you know, people will start looking at some of the international peers. So today, Downer's on less than 15 times. Some of these international peers are trading closer to 20 times.
Wow.
So there's a material re-rating opportunity if Downer can manage to move on some of these capital-intensive businesses. So that's one that I think could materially re-rate.
Excellent. And I suppose the common theme there is the valuation opportunity we see within those 2 companies. There's been a lot of talk in the market about value, growth, valuations not even mattering in a low interest rate environment. What's your view on the value growth argument, and how are we positioned in our portfolios?
Yeah, the value growth argument is, to us, as simple as interest rates. As interest rates fall, long-term cash flows become more valuable, and so you see re-ratings in those stocks, and conversely, the value stocks won't re-rate as much. So there's many things going on, technology, etc. But at the end of the day, interest rates are what's changing it. And so this value growth rotation, it happened in the first week of September, around 2 days in a row. It was very, very powerful, very, very vicious. But if you plot value growth against 10-year US bonds and yields, it was perfectly correlated. So if you think interest rates are going to rise, and no one does at the moment, but if you did believe that was going to happen, that would be further fuel on the fire. I mean, as far as it goes for Firetrail and for our investors, we don't try to get caught up too much in picking the value growth. We like to call ourselves valuation investors rather than specifically value or growth, because we're looking for any company that's trading a material discount to its history or its peer group, or where there's an opportunity looking out 3 years to realise some really good value. So we continue to invest across the spectrum. I would say at the moment though, if I had to put me on the spot, I'd say we are a bit more value focused, so lower PEs than the market. And that's really a function of where we're seeing the opportunities. So we haven't changed our stripes, we haven't done anything differently. But we are just continuing to look for those really good valuation opportunities. And that involves investing in something like a Qantas, which is on a very low PE, or something like, say, a Cleanaway, which is trading over 20 times. So we'll invest across the spectrum.
And sticking with the portfolio, over the past quarter, changes to the portfolio and how you're positioning?
Yeah, so probably the biggest change was adding to base metals in the portfolio. We've really only owned Rio as a resource company exposure. We've also owned Orica, which is more mining services. But we made the decision after a fair bit of research and watching the markets to add to base metals, in particular copper and alumina. And the reason we did, and the two stocks there were Oz Minerals in copper and AWC, which is alumina in the alumina space. The reason we did that was that in the short term, demand is what's going to drive resource prices. So when people worry about demand, they sell oil, they sell copper. But in the medium and long term, it's always about supply.
Yep.
That is the key fundamental thing that drives resources. And so what's happened in both cases, you've seen, in say copper, you've seen weak demand, but you've seen really weak copper supply as well. You've seen a lot of outages. Chile, Peru, which are the two biggest countries for copper supply, have been disrupted through strikes and protests. You've seen water issues. So the demand issues have swamped the supply issues. But if we do see some kind of more normalised demand profile, which we do see, you can see pretty good re-rating of, say, the copper price. And the same goes in alumina, although it's a little bit different. For alumina, AWC, the company, they most recent quarter, they produced alumina for $203 a tonne. At the moment, the price is $280 a tonne, so they're still making good margins. But at $280 a tonne, Chinese producers of alumina are losing money. And so we can see the price re-rating, and I think demand could potentially be a catalyst there, where you just see a bit more normal demand pattern. So we've added to base metals. To fund that, we've trimmed some of our Woolworths position. We love Woolworths. We've been a huge fan of the strategy that Brad Banducci's putting into play, but trading at 26, 27 times PE, there's a lot of expectation in there. So we still have a position, but it went from being our largest position going back probably 9 months ago to a much smaller position outside of our top 10. We've also trimmed some of the banks as well. You've got house prices have now stabilised, credit growth not looking too bad, but you've still got competition and you've got pressure upwards on the cost line, which they're trying to offset through cost out. But these remediation costs and continued compliance costs still are eating away at them. And so they look okay, but we just think there's better opportunities out there.
Another big thing we do at Firetrail are the research trips and the research programs. You've been travelling domestically and internationally over the past quarter. Can you give us a couple of key insights from your research trips?
You're right, we've been away a lot recently, Asia, Europe, US, and then even yesterday I was in Melbourne at a Waste Expo. A couple of key highlights for me. One at this Waste Expo yesterday, which we were going there for Cleanaway to really understand some of the big changes. The biggest change has been China's rejected the world's waste. That waste is now going to have to be processed in Australia, and it's going to be a mix of recycled and landfill. Some of the players in the market were basically picking up rubbish for $20 a tonne, sending a fair bit of it to China. That is now going to be repriced to probably over $100 a tonne.
Wow. And
so one thing that we really came away with was that this industry is corporatising. You're going to see some of the smaller players leave the industry, and that's going to be really good for a professional company like Cleanaway. When we were in Asia, one of the key takeaways I think was the whole Beyond Meat alternative meats. We ate some of the mung bean eggs, scrambled egg replacement.
What did you think?
I'd say good, different. Definitely different, but I'd say good, different. And you just get this really strong feeling that this is going to be a really big theme coming through the FMCG industry and also the supermarket industry. So I'd keep an eye out for that one. In Europe, things have been slow. They've been slow for a while. We've been going to Europe for a long time. Things are just slow there. I think it's been extra slow. You've had an extra dip from probably a trade war destocking. And so you probably can see a bit of an inflection in demand, things getting a little bit better, but still you are in a low growth environment. And then coming out of the US, the biggest one was just how far interest rates have moved and the positive that's had for US housing. So there's a lot out of those research trips, but I'd say they were probably some of the key takeaways from that.
Switching gears a little bit from the portfolio, something we've done every single year since we've been doing these videos is focus the spotlight on the consumer at this time of year, coming into Christmas.
Yes.
And the question I always ask you is, what are the hot Christmas gifts on the Henricks Christmas list coming into this year?
Yeah, so as you know, big fan of board games, and this year it's a game called Flamme Rouge.
Flamme Rouge.
Flamme Rouge,
Okay.
which for cycling aficionados out there is the last kilometre in a bike race, in a Tour de France, etc. It's where the legs are burning, and it's a great game. I play it with my kids. Basically, you're incentivised to stay in the pack and then sprint at the end. But if you take off too early, which my son, who's 5, loves to do, you get these fatigue cards and you come right back to the pack and everyone overtakes you at the end. So it's a great lesson in life and it's an exceptional game.
Okay, Flamme Rouge, all right.
What
I'm
about
gonna
you,
check
Kyle?
it
You
out.
got anything for us?
I do. Well, Blake, I've got 2 young daughters in my household, and something that's coming up in November is Frozen 2. So it's all about Disney, and it's all about Disney characters. My eldest daughter loves dressing up as Elsa, and she's dressed my baby daughter as Anna. And so we're looking forward to Frozen 2 coming out, and everything's Frozen 2 themed in our household leading into Christmas.
How good's that? I think we're all looking forward to Frozen 2.
It's great for Disney. Blake, thanks for joining us today. And thank you for joining us for Firetrail's quarterly update.